All right, welcome to this explainer, where we're digging into a fantastic analysis from Web Cornucopia Finance. We're looking at a company that's literally at the heart of India's financial markets. It's the digital plumbing that makes the whole massive industry work. Okay, so to really get what makes this company tick, you first got to understand the absolute tidal wave it's riding. I mean, India is going through this historic shift in how people save and invest their money, and the scale of it all is just, it's enormous. Let's use three numbers to really paint the picture of this boom. First up, 5.7 crore. That's 57 million active, regular investment plans. This isn't just a number. It points to a massive cultural shift toward disciplined, consistent investing. It's becoming the new normal. Next up, just look at the sheer number of people getting in on the action. We're talking over 40 million unique investors. And what's really wild is that this number jumped by 26% in just 1 year. So the investor base isn't just big, it's growing at a breakneck pace. And finally, the total amount of money being managed? 50 trillion rupees. It's a truly staggering amount of capital. And get this, the industry thinks this number could double in the next 5 to 6 years. The potential for growth here is just immense. So what's the bottom line here? We are witnessing a huge migration of savings. All this money that used to go into physical stuff, like gold or real estate, is now flooding into financial markets. And that creates this incredible opportunity for the companies that build and maintain the infrastructure for it all. So where does all that opportunity lead? Well, it leads us to a company called Computer Age Management Services, or CAMS for short. This is the company that's, quietly running the whole show in the background. They are the essential backbone for the entire mutual fund industry. So what does CAMS actually do? It's important to know they're not a mutual fund themselves. Nope. They are what's known as a registrar and transfer agent. Now, that sounds a little dry, I know, but think of it this way. They're the central nervous system that every single fund needs to operate, handling all the complicated, high-volume record keeping. And this brings us to the market itself. And what you see here, it's a classic duopoly. The whole industry is pretty much controlled by just two players. And CAMS? Well, they are the undisputed heavyweight champion with a commanding 68% of the market. And their dominance really comes from having the biggest players on their roster. CAMS handles 10 of the top 15 largest mutual funds in the entire country. That gives them incredible scale. But notice that little detail on the right? Their only real competitor, fintech, is actually growing faster right now. And that's a really important piece of the puzzle we're going to come back to. Okay, so with all that in mind, let's explore the bull case. These are all the reasons why so many analysts are so optimistic about this company. We're talking about the deep, structural reasons why this business is just so hard to compete with. These are what investors call moats. Deep advantages that protect the business like a fortress. Things like high switching costs. I mean, once a fund is on their platform, the cost and the headache and the sheer risk of trying to move are so high, they're basically locked in. They're not going anywhere. Now for a few financial hero stats that really show you how powerful this business is. First, return on equity. So simply put, for every 100 rupees of capital that shareholders have in the business, CAMS generates over 41 rupees in profit. That is just incredibly efficient. All right, next up, it's core operational efficiency. This margin tells you that almost 45 cents of every single dollar in revenue turns into profit, before you even account for things like interest and taxes. That's a sign of a beautiful, high-margin, asset-light business. And to top it all off, look at this. This number shows you how rock-solid its finances are. A debt-to-equity ratio this low basically means the company has no debt. It has a fortress-like balance sheet, which gives it a ton of flexibility. But of course, it's not all sunshine and rainbows. The analysis also points out some pretty significant risks. So let's flip the coin and look at the bear case, because you've always got to look at the risks, right? The number one risk, the price tag itself. A price-to-earnings ratio of nearly 40 means this stock is priced for perfection. There is very little room for any mistakes. And then there's that competitor we mentioned, plus the simple fact that CAM's success is tied directly to the ups and downs of the stock market. And this quote right here just captures that valuation risk perfectly. Because everyone expects so much, even a tiny miss on their growth numbers can make the market punish the stock. And that's exactly what we saw happen right after their last earnings report. Okay, so you've got this fortress of a business, but you've also got these potential cracks. How do you put it all together? Let's get to the final synthesis and see where the report lands after weighing all the evidence. Now, this is super interesting. Instead of just trying to guess one single number for the future, analysts build out different scenarios and assign probabilities to them. You can see the most likely outcome, the base case, with a 60% probability, assumes 15% annual growth and leads to a target price of around $4,200. And so at the end of the day, after weighing the fortress-like business, the financials, the risks, and all those scenarios, the report's final recommendation is a buy. The analyst believes the huge long-term structural growth story here is just too powerful to ignore and that it outweighs the near-term risks, which justifies that $4,200 price target. Which leaves us with the final and I think the most crucial question here. It's really the core of the debate for a company like this. For a business that is this strong, is paying a premium price for the stock just the cost of buying quality? Or is it a sign that you're actually taking on too much risk? That's the question to really chew on.